Okay, here we are, week 3, and welcome to Dollars and Making Sense. Henry, welcome again.
That's right.
And we're getting to get into a bit of a routine now, and I'd certainly like to reach out and say thank you to all our subscribers that have subscribed thus far. And again, we're getting a bit of mixture from the radio show as well as from the YouTube video cast. And don't forget, we're also available on the internet streaming off the blog as well as at Radio Northern Beaches. So let's kick off discussions and let's pick up from last week. Henry, what's your view of what's been happening? There's Super Saturday that occurred in the UK, and Boris is still looking fairly bullish. But what's your view?
Yeah, I mean, I wrote an article on Saturday for the newsletter talking about whack-a-mole risks, and when you whack down one risk, another one pops up. And of course, Brexit is a significant risk out there for not necessarily for us, but more for the European economy and of course the UK economy. And there was a crucial vote on Saturday, which got basically Boris lost that one as well, so he's doing as well as the Irish team at the World Cup. But it's interesting. I mean, it would appear that he's going to really struggle to get this through. There's another vote, I think, on Monday today.
Yes, so I read, yes.
I mean, the definition of insanity is trying to do the same thing when trying to get a different outcome.
But again, my read of what he's trying to push through is actually weaker than what Theresa May tried to push through.
Which he voted against.
Which he voted against 3 times.
Yep.
And so here we are trying the same song with a weaker message, and the DUP saying no thank you.
Yep.
And he's still hopeful it's going to get through.
Yeah, I mean, I guess it just comes down to a game of chicken, really, and whether the holdouts and the doubtfuls will actually sort of work on the basis that October the 31st is a week or so away, and they better get something sorted. If otherwise, we're going to be delayed till January. How palatable that's going to be? Will there be a general election? Of course, there's issues there. Jeremy Corbyn is unelectable, really for Labour. So it's just chaos again in the UK. It really is. So that for us, that's just another kind of whack-a-mole risk. And of course, we had another weekend of violence in Hong Kong with those protests, which again, it doesn't appear to be a significant risk for equity markets in itself. But if China was to clamp down heavily on Hong Kong and the US reacted angrily to that heavy-handedness, and then the trade talks, all that sort of fizzled out in a Hong Kong blaze of glory, then that wouldn't be good for the markets, because we are now sort of baking in phase 1 at least of a trade deal.
So again, we talked about Trade-Lite last week. What's your view? Do you still see that as going through?
Well, taking away the politics of it, yes, I think is the answer. At some stage, the two of them are going to have to come together and do some sort of deal. The deal they've got on the table is pretty much a very cut down, watered down version. Of course, it could change, but it is pretty much buying agricultural products, pork and beans, a bit of IT stuff, a bit of opening up markets, a bit of nice sort of motherhood statements. But at the end of the day, it doesn't really address the big issues which are going to be pushed further down the track. But looking at the Chinese GDP, which came out last Friday, that was the weakest in 30 years. So clearly there are some effects happening to the Chinese economy. Certainly the US economy is slowing down. So both of them need to do some sort of, at least hold the line, keep things as they are rather than escalating it further.
It's a good segue, I guess, into discussions around the IMF and their warnings of a synchronized global downturn, because you've got China's numbers dipping. You've got the UK numbers are dipped. I don't know how much further below they can go right now, with a potential 7% hit on their GDP if Brexit goes through. And now the IMF's come forward and said, listen, Morrison government, your forecasts are fanciful, and they've cut those in half. So, it's nothing that I think any real economist would be surprised by. But again, we've still got a government saying nothing to see here, nothing to see here. Please look the other way.
Yeah.
I'm scratching my head. Investors are looking at the environment, sort of going, well, gosh, who's right and who's wrong?
Yeah, I mean, it is a tricky one. It does appear that the Morrison government has been sadly absent since the election. In fact, sadly absent since the beginning of the year, really.
But I'd hazard a guess, not just them, but also the predecessors, the Turnbull and Abbott versions. We're talking 5, almost 6 years of inaction.
Yeah. Yeah, it's not good. I mean, that's the thing. It's not good. I mean, Morrison's been swanning around overseas and making buddies with various world leaders, which is part of the job. There's no doubt about it. But certainly, the Australian economy is slowing. The RBA cannot rescue it all by itself. The government is completely convinced that having a surplus is the way to go. Now, that may or may not be right, but it's going to be a tiny weeny surplus. They've got $510 billion worth of debt, cost $19 billion to service that debt. These are big numbers. That debt's grown.
And that's not Labor debt, is it?
Well,
they keep on harping on about it's all Labor's fault.
I think when Labor left, they were at sort of 300, and now they're at 510. So it's not Labor's fault per se, but Labor certainly put some plans in place and some policies in place, which meant that budget was going to be in a worse position. So it's at the end of the day, it's no one's real fault. There's a bit of Labor, there's a bit of the Liberal National Party in there as well. But the reality is it's $510 billion or whatever it is. When you get your tax return back, it gives you a breakdown of where your tax.
Yeah, I see that these days.
It's kind of interesting to see where it all goes, and $19 billion goes in servicing those interest rate payments. And you know what? We've got record low interest rates. No wonder the government is kind of keen that we have record low interest rates, because otherwise that servicing of the debt would be...
They'd be in big trouble.
They'd be in big trouble.
As would most first world economies, given the level of borrowing.
The US has got $20 trillion worth of debt.
Oh, it's astounding.
Yeah.
It's just astounding. But again, I always like to bring these macro events back into micro impacts. And so for the everyday, punter, I get an Economic Weekly from the Australian Institute of Company Directors, of which I'm a member. But I like reading Mark Thirlwell's take on the economy. He plays with a very straight bat. And again, even though he represents a pretty right-wing group, being the Association of Company Directors, they are traditionally fairly right-wing. You can't sort of cast it any other way. While he's saying unemployment's sort of seasonally fallen, we're still talking about a situation where financial markets may not nudge interest rates again because of that. But again, the unspoken thing is underemployment. If we add the under and unemployment numbers together, it's still a pretty frightening number. Yeah,
and a lot of people have 2 jobs, 3 jobs. They have to. They've got no choice. So, I mean, things are not great, let's face it. The index, the ASX, bringing it back to, in terms of market terms, we're 200 odd points below the all-time high. So there's still a fair degree of optimism built in. And we are seeing, at the moment it's AGM season, so we are seeing some earnings forecasts, updates, guidances, which have been, to be honest, they've been kind of where you would expect. Nick Scali, for instance, came out and said that their sales of Italian sofas are not doing too well, and the trends they've seen since August have not changed in October. And
so that's a discretionary spend.
That's a discretionary spend, and that's despite people were buying Nick Scali on the basis that maybe we would get the housing recovery would drive sofa sales, which is kind of where it goes. Harvey Norman,
a plastic-covered lounge suite recovery.
Well, there is that. So in theory, Harvey Norman does well from apartment sales and all this sort of stuff. But then we had numbers out today with off the plan apartment sales, absolutely terrible in terms of resale values, in terms of people losing the money. But
wouldn't you suggest that's got a lot more to do with building code?
Oh, of course it has. But still, it doesn't do anything for Nick Scali. It doesn't help Harvey Norman. So, and we saw this with there was another company which has just escaped me. But again, it was even saw it with Bank of Queensland coming through with their results. Again, challenging times, headwinds, economy struggling, consumer sentiment down, business investment down. There's not a lot of confidence out there. It's hardly surprising when you get continually bombarded in the papers. Front page of every paper is news of doom and gloom, and that starts to seep into your psyche as a CEO or whatever, and you stop spending, you stop investing.
Well, I don't blame them though, Henry. I mean, we've got an RBA that can't forecast. We've got a government that
they've never been able to forecast.
No doubt, but I mean, we've got a government that's saying we're building our surplus on the basis of growth rates that are just pie in the sky. We're never going to hit 3s at this point in time. We're lucky to be hitting 2s at best. And so that's an enormous impact when you don't grow the way you suggest you're going to grow. And that has impact on intake of dollars, tax revenues, etc. And the flow on just keeps going.
It does. But at the end of the day, if the government can deliver a surplus as far as they're concerned, That's all they care about in terms of electioneering and sort of taglines. We delivered a surplus. Even in tough times, we delivered a surplus. And they will do it by tricky means. It may be
and underspend of $4 billion in the NDIS.
That sort of thing. The same as they're
malarkey.
going.
I mean, it's just ridiculous.
I don't want to get into too much politics, but certainly, there's some tricky figures coming into the climate change goals as well in terms of what their carbon emissions are. So there's a lot of trickiness around. So they're not alone.
Lies, damn lies, and statistics.
That's the one.
Yeah, so, again, according to the AICD, we're looking at a potential synchronized stagnation. I love that word, stagnation.
Yes. Yeah, it has become that. I think that's but it could be easily fixed. This stagflation could be fixed overnight if China and the US said, hey, you know what? We're going to do phase 1, 2, 3. Then there would be a kind of an unleashing of animal spirits in terms of CEOs going out and saying, okay, we need to take advantage of this now. Let's move.
So it's just a matter of Trump and Xi Jinping just getting around a cup of cha and working it out.
Well, when you think about what's caused this global slowdown, it is primarily a function of nationalism and putting economies behind barriers and isolationism. And
that's the whole basis of Trump's presidency.
I know, but
from his inauguration speech.
But if you solve that,
America first.
If you solve that tomorrow, well, America first, and everybody else last. That is certainly the case. But if you solve that, and it could be solved. I mean, let's face it. You walk back the golf club invitation. If he solved that in a tweet, then the world wouldn't be a bad place again. So the risks that we have and the problems that we have in the world are primarily a function of the resident of 1600 Pennsylvania Avenue.
I feel rather sad though for the Kurds, because if they had a piece of turf in that area of Kurdistan that resembled something close to a golf resort, they may have better prospects with Mr. 45.
Unfortunately, they've been priced out of the market.
No, haven't they what? Okay, let's have a look at a couple of the companies that we looked at last week, and Latitude was one of them. Any update on Latitude?
Yeah, there's a lot of post-mortems on Latitude. This was a very high-profile float with a very high-profile CEO at the helm with lots of millions of dollars to gain if it floated. It didn't. This is the second time it's failed to fire. Second time. The question is, I guess, now what do the owners do with it? The owners being private equity. Mainly. So what do they do with Latitude? Clearly, Mr. What's his name? Mr. Fayed. Remind me. Anyway, the CEO, Ahmed Farouk, has now got a job to do. He's actually now got to produce a business that is worth more, that can do more, that can either be sold as a private kind of company rather than floating, because I can't see them doing it 3 times, and trying to justify what the story was, what the narrative was about this growth. I'm not sure that's going to be there, but I'm not sure if he'll hang around for the long term. But it's interesting, and that does have a knock-on effect, because there are a number of other fintechs in the pipeline that were probably looking very much to Latitude as if this one gets away successfully, as
a potential bellwether.
Yeah, if this is successful, then we'll be successful. If you're not, then the question marks remain over those as well. Yeah,
third time doesn't sound so lucky, does it?
It's tricky.
Yeah. One of the things that we talked about last week as well, Latitude has a credit card, and I decided to have a bit of a look under the covers. I'm a big... I actually like credit cards. I'm one of these people. I've actually had one since I was 18 years old, when they had bank cards. Remember those? And I've had more than one over that time. But over that period of time, I'm almost 60 years old. I've had a credit card virtually my entire life. And in all that time, I've only ever paid interest on a credit card once in my life, when I first got married, because I love using them, but I pay them off every month.
You're one of the very few.
And I'm one of the kind of clients that they absolutely hate. They hate me big time because I pay it off every month without fail, so I don't pay interest. But I had a look at the Latitude credit cards, and again, the terms and conditions around credit cards, to me, are akin to mobile phone plans. They make them so complex and gnarly that, the poor old common punter is looking at them going, I really don't sort of know what's going on. But again, Latitude are advertising no fees, no exchange rates on international transactions, They have the standard 55-day interest-free period, which is what I always look for. And then they have these extras. And one of the extras, for example, was if you're traveling and you get delayed, having a Latitude credit card will give you access to a lounge where you can go and have a shower, you can get internet access, and the like. But then I had a look at the fine print. Yeah, buyer beware. And it's no different to the kind of travel insurance clauses that are offered in these credit cards. I simply look at people and say, you know what, if you get the chance to ever claim these kind of perks that they provide, good luck, because I think that the kind of terms and conditions around how long the delay is, where the delay is the airport lounge that you're in actually participates in this program scheme or not. It's like, you know, every Kentucky Fried franchise has these little givers, but the little fine print says, but not all franchises has the opportunity. So again, my big thing, when I look at anybody that offers no fees on exchange rates, you know what, you can go to the airport today and exchange your money there, and they will have big signs that says no fees. But what I would also suggest to you is that if you're buying an American dollar, for example, at the airport today, you'd probably pay 64 cents to the dollar there, whereas at the high street bank in town, you're paying 67 or 68. Nobody pays attention to the rate because that's where they're making their margin. And again, yes, no fees, ... but my exchange rate is crap. And so I think when I look at the Latitude credit card, I look at it, it's 23.99%. So again, if you overspend and can't pay, you're in big time, and that 55-day credit free goes until you pay the entire amount off. And this is where the kind of financial advising I've done in just helping people through their budgets, and they don't understand their credit cards. The most basic of credit facilities that are out there today, and everybody has one. They don't understand them. And believe me, it's a great grab for these guys because they're making tons of cash on fees. Consumers, that's you. So read the fine print. It's really, really important. So Latitude's credit card, for me, no different. You know, all these freebies there, I don't think they're all that free. And all the no fees, they're going to make you pay somewhere else. They can't afford not to. Okay, so that's Latitude. We also talked about Praemium PPS.AX.
Yeah. This is a platform provider for self-managed super funds and people who run separately managed accounts like we do.
That's right. That's the fintech platform, right?
Yeah, fintech platform. They've got a big business in the UK which has been struggling, and they have been rallying, I guess. Recently they hit rock bottom. The numbers of the funds under management have been coming in quite positively, but markets have been a little bit suspicious of it. It was a previous high flyer. A lot of these platform stocks have been high flyers, the Bravura, the Hub 24s, the Netwealths, the Praemiums. So, you know, it's a function of the Banking Royal Commission to some extent because of all the problems with the banks. People have used that as an excuse to take their money out and put it elsewhere and manage their own affairs and put it off these sorts of platforms. So the stock's been doing relatively well. You know, it's been going, you know, slightly higher every day. And I think last I looked it was around 55 cents. So it's been doing okay, not spectacular. And I suspect that, you know, any bad news about Brexit will kind of take some of the optimism out of that because they have got a big UK business, and they were hoping, and the market was hoping, that if you got Brexit out of the way, then maybe the UK will sort of perk up. I mean, interestingly though, even when you look at the UK economy, which may take a hit because of Brexit, their index is still pretty close to all-time highs. Yeah,
but again, that's more a factor of, you know, money looking for a better home than sitting in a bond.
That's always the way. Yes.
Okay, interest rates go down, equities go up. It's a natural course here, looking for a better yield.
Yep.
Okay, good. Okay, also one of the biggest companies in the world that's have they floated yet, Aramco?
No, and I think they've delayed the float again. Aramco is the Saudi Arabia's
big oil company,
oil company basically, which has the biggest oil reserves in the world. They are looking to float a tiny, weeny proportion.
You mentioned last week 5%.
I think they're even talking about 2%.
Wow, only 2%.
But it would value the company, and that's the important thing, at around $2 trillion. It would be the biggest company
by some
in the universe.
That's double.
So you know it's a big deal. There's a lot of people lining up for this float. Obviously, there's a lot of exchanges still vying for this float. And I mean, floats
just on the fees alone.
Yeah, I mean, floats are a relative term because there's not really much of it floating. 2 to 5% maybe, but at least it will give some sort of valuation to that from their perspective.
But the harsh reality of those kind of IPOs, Henry, do the everyday punter actually get a view of it, or is it really going to the institutions that get a play at that kind of IPO?
I don't know if the everyday punter will get much of a look in. If you're a relatively big punter and you've got a good connection with a broker, maybe, but and it depends how lucrative the float actually looks. If at the end of the day, if you get offered an IPO as an everyday punter, usually there's some issues with the IPO. There were lots of people offering Latitude towards the end of the process. So sometimes you don't want to be offered the IPO because
what's wrong with this? It's like you're looking at why haven't the institutions lined up?
Yeah, well, that's exactly. But if the purpose of the loan the float is to broaden its shareholder appeal globally, then it may be that you do get a look in. Who knows? But
But it always is the case. Buyer beware, right?
IPOs always, but we've seen some pretty successful ones recently.
I must tell you as well, Henry. I was meeting with one of my regular discussion group attendees, and he's also a client of mine. But he actually listened into your piece last week, and he just laughed. He says, "I like Henry's view about the glossy brochure. The glossier, the more wary you got to be."
Yeah.
And I thought I'd feed that back to you because that's going to be one of Henry's classics. We'll put that up in lights.
You've always got to be careful. Smoke and mirrors. It's the screen in The Wizard of Oz. You just got to be careful.
And again, we're at that point in our program. Maybe you might want to read this just to make sure that people understand.
Yeah, thanks for listening to Dollars and Making Sense. We're a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Obviously, any comment is general advice only and does not take into account your objectives, financial situation or needs. And so you should consider whether the advice is suitable for you and your own personal circumstances. So if you're in any doubt, please contact your own financial planner or advisor.
Absolutely. And again, we will continue to disclaim early and often because, as we say, these are our opinions, these are our views. But if you are going to make any kind of investment, please get some advice. Ask around. It's sometimes good to just check. And again, I love referring back to the Dick Smith IPO, when a hedge fund came along and magically within 6 months they doubled in value, and I was scratching my head, and we all know how that ended in tears. Not well at all.
Not well.
Okay, we have on our list to have a chat about this week as well is WiseTech. Tell me a little bit about WiseTech.
Talking of not well, this is a high-tech logistics company that's been around for a long time. It's run by a guy called Richard Wise, and it has been an absolute stock market darling. It's got a PE of 120 odd.
Whoa!
It's not cheap, and it has done a string, and I mean string, of acquisitions across the globe of small logistics software providers.
Are they an Australian company?
They are an Australian company, but they've been buying little businesses, little logistics providers, software providers in different countries, obviously for their own in-country expertise. Now, all was going well. All was going fabulously well until last week. And last week, a company called OTG Capital, which is based in Beijing, which is important to bear in mind, issued a report, and they are an aggressive short seller of WiseTech, and the report ran to 29 pages, which basically questioned the WiseTech accounts and their whole methodology, their whole auditor, pretty much everything, the whole business. The stock, this report was solely for their clients, not supposed to be distributed, but of course, boing, it's the cat's out of the bag. The stock dropped 10-11% within half an hour. The stock exchange suspended it.
It's probably a wise move, yeah.
Which was a wise move.
No pun intended.
No. I wrote a big article on this on Friday, a little bit contentious, about short sellers and these aggressive short selling funds and the work they put in, etc. Whether it's right or wrong, people have their own views about short selling. But I wrote a kind of a controversial article. I'm surprised I didn't get much pushback, to be honest. But on Friday night, WiseTech came out with a 4-page rebuttal to all the allegations. Evans and Partners as well, a broker, put out a research piece, still valuing WiseTech at over $35, and all was going to be right with the world. Monday morning they opened, they fell 10% on the open. So clearly the 4-page rebuttal wasn't enough.
No.
And also the fear was that J Capital would come back with part 2. The stock rallied, it was down around 4% after about half an hour. So there were some buyers looking for value. Then the rot set in again, and once again we saw the stock slide, and it was down 12% when they got suspended again. And there was another report put out by J Capital. Remember their Beijing base.
Another confidential one, right?
Another confidential one, which I got within a second of
that just so happened to be on the internet. Right.
Actually, this time ran to 33 pages. 33
pages?
And
My
I
word.
got to about page 25 and thought, oh, this isn't good.
But was it accurate?
It's, you know what, it's very hard for the layman or even someone like me to assess whether it's accurate. A lot of their stuff was based on interviews with people that work for the companies that they've taken over.
Right, okay.
A lot of it was based on, not anecdotal, but certainly inside knowledge of the logistics business, which, clearly they'd done the work, had done the interviews with people. So I don't know. I'm not privy to those interviews. I can only assume that with 33 pages of this stuff, and I've read 2/3 of it, there was still some serious question marks there over WiseTech and their business. And it's the old thing where there's smoke, there's fire, or the graffiti thing. And clearly this morning the market wasn't impressed with the 4-page rebuttal. They were still down 10% before this report came out.
Right.
So there's some question marks over it, and I've no doubt that WiseTech will come out again, and there'll be a lot of people leaping to the defence of companies like WiseTech. But you've got to remember sometimes that I wrote that it's a bit like having the fourth estate, that the media is the fourth estate of our society.
Certainly.
It shines a light and questions things, and that's what we want. We want a free press. And I did argue that maybe people like J Capital are providing a similar service in the corporate sense. Where was J Capital when Enron was going on? Where was it when, we've seen it with Blue Sky, we've seen it with Quintex, we've seen it with, Slater and Gordon. We're not exactly, we haven't got a great track record here. So
no, and again, when you're trading on a PE of 120, and again, for those that understand, a price earnings ratio means that, there's an expectation of 120 times.
Yeah.
Of earnings on what the actual price is today. So it's an incredibly overvalued stock.
It is, and it is based a lot on growth, clearly. I mean, that's the whole point of this. Future growth. And the question marks that J Capital put in is that this growth is actually overstated. Therefore, the 122 PE is massively overstated. So it remains to be seen whether who's right, who's wrong. It goes to credibility, it goes to integrity, it goes to a lot of issues. And these guys, they are usually domiciled overseas because they aren't subject to the same rules and regulations. Most companies here, if you were UBS or whatever, or a Macquarie and you were doing a research piece, you would run the research piece past the company to make sure that all your numbers, your models... Well,
you're validating the data points, I guess. But again... over the weekend, Wise management had the opportunity to rebut. And if after a 4-page rebuttal, the market sort of sat back and went, not so convincing.
Well, that's the problem. And you always know that there's going to be a part 2. You don't go out and attack a company like WiseTech or an Afterpay or a Quintus or whatever company you're going to attack, or a Blue Sky, without having part 2, and I'm no doubt there'll be a part 3 because it will just go back and forth.
It will. And so for investors in WiseTech at this point in time, what's your feeling? What do you think they should be doing?
Well, they can't do anything as far as the stock market
It's still
goes.
suspended?
It's going to be suspended probably till Wednesday, they've said. You're in for a volatile ride. And the problem is that once... once there is a smell about a company, it does take a while. We saw it with rural funds. They came under attack by one of these sort of hedge funds, short sell, aggressive research kind of driven people. Sure. And the stock dropped like a rock. They rebutted it and got pretty good response from the rebuttal. It was a pretty good and sensible rebuttal. Stock price rallied back up, not to where it was beforehand, and then has kind of drifted off, flatlined since then, and now its lawyers at 10 paces. I suspect that will be the playbook.
And again, just please question my basic maths. So if WiseTech, for example, within the next sort of couple of weeks come out and double their earnings, okay, theoretically, their PE still only halves. It's still at 60, correct? If my maths is correct.
Yep.
It's still pretty robust PE number that we're talking about.
It is. Yes.
And so that's really the difficulty. Even if they come out with earnings, it's going to be hard to sort of stand up and say we're worth what we're currently trading at.
Yeah. I mean, the problem with WiseTech, and there has been two schools of thought on this, and I've kind of fallen into the latter camp. The first school of thought says, these guys are geniuses, and all the roll-ups, all the companies they're taking over are really good at acquisitions, and it's all working fine. My concern has always been throughout all this is that you do acquisition after acquisition after acquisition. It's a big thing to do acquisitions. Whether it's a $3 million acquisition, 20 or 100. The paperwork's going to be the same. It's just the money number that changes. And the integration issues are still going to be the same.
And there you highlight a good point. And part of my background, I came from the IT industry before I came into finance, and I used to work for a company called Cisco. Remember those little guys?
Yeah.
The makers of the internet. Now, I was actually part of an acquisition. We got acquired by Cisco. And in that particular year, in 99, Cisco acquired 7 or 8 companies, and they were just doing it on a roll.
Yeah.
What they never told you about, though, 12, 18 or 24 months later, they either trashed the technology, the people left in disgust because the culture wars and the mismatches or the like.
Yep.
Acquisitions are unbelievably difficult.
They are. And WiseTech hasn't done 7 or 8. They have done 25. In a short period of time, since IPOing, since coming to the market, they have done a huge amount of acquisitions. And the basic premise that J Capital is saying is very similar to what you're saying.
It's extraordinarily
once they
hard.
come in, integration is a problem, staff leave, customers leave, the new product's not up to scratch, they can't, there's lots of issues. And this is the same we saw with ABC Learning pre-GFC. It was acquisition of childcare centres after childcare centre after childcare. There's a risk with these roll-ups.
We've got a situation even with one of the companies I've used, MYOB, when they took in Sol 6, we're talking disparate technologies and they're trying to mesh them together. Different development teams, different customer service. All of a sudden they bring them into a love-in and they say, hi, we're all one. And they're looking around going, well, gee, you don't look like me and I don't look like you. And just because we've got the same banner, and Telstra has had exactly the same problems. I mean, the number of acquisitions that Telstra have gone through and failed miserably at
it's
extraordinarily difficult. Again, that's a good segue because I actually have Telstra on my list of discussion points.
Oh, really?
Yes. I know you're a small cap guy, but I was just curious because there was an interesting piece during the week about Telstra and whether they could be worth less than $2. And I just checked their ticker before we came on air, and they're trading at around 365. So if we halve that to $2, a lot of mums and dads are going to be pretty darn concerned.
Yeah, I don't know the premise of his argument why they're...
Well, NBN transition costs is primarily his big thing.
Right.
Still a lot of money in mobile, and the margins are holding up quite well. But the bottom line of the mainstay of Telstra's business is walking out the door to the NBN.
Well, the NBN is rubbish. Let's face it, the NBN is terrible. Having spent some time in the UK, working from there with their internet compared to our internet, they are head and shoulders above where we are, and they think they're backward.
So, too many countries are saying the same about our NBN.
Oh, it's shocking. It's shocking. If it rains in our house, we get the little spinny thing and the buffer and the whole spinny wheel thing, the rainbow of death. The big driver of Telstra, the big driver of Telstra growth is 5G. That is the core of Telstra. They have a big hole in their earnings because of the NBN. They have been compensated for that through the government.
But that's going to run out very shortly, isn't it?
That does run out, although they do still get a revenue every year for allowing the copper wires to be used. So it is a rental scheme as well over time. But the big upfront payment runs out. And hopefully they can work their way through the valley of the shadow of death into the promised land of 5G and therefore that will reinvigorate their profits, which is the hope. But my phone is 4G and it works just great.
Well, again, I'll be watching this one simply because, again, just bringing up their ticker today on Yahoo Finance, their earnings are declining year by year by year.
Yep.
And so the dividends are going to be harder and harder and harder to keep paying. And that's why a lot of mums and dads are investing in Telstra, because of dividends.
Yep.
Anyway, we'll cut that one because we're running close to time at this point in time. So I'm just looking through my cheat sheet here. Probably the last thing, again, a quick note, again from the AICD, a rising confidence in the Australian housing market. Are you seeing that?
I think anecdotally, yes.
So am I. I just saw friends that sold in French's Forest on the weekend. A 1.4 reserve went at 1.95.
Well, I think
unbelievable.
Well, I think the problem at the moment is that there is nothing around. There's
no stock. So
there is no stock.
Yeah.
So what stock there is getting bid up. But at some stage, that stock will come onto the market, will flood the market. I imagine that's in train at the moment.
It is.
And you will get a supply response to the demand response. At the moment, we've had a limited supply and demand quite high. And that's going to stop at some stage.
Okay, so to round out this week's commentary, let's have a look at any other final companies you think we should be looking at and our viewers and listeners should be paying attention to between now and next Monday, Tuesday, when we are broadcasting.
Well, the big one to keep an eye on is the banking sector. We have got bank results coming up in about, they kick off in about a week or so.
Uh-huh.
So that's the sector. They're 30% of the market. So it'd be interesting to see how the banks, traditionally they rally into the results. And there's a lot of bad news in the banks already. And hopefully that bad news is in the results. But that's going to be the key to our market. And if we can get some sort of trade resolution and the banks do okay-ish, Santa Claus rally could be unleashed.
Okay.
At the moment, it's a lot of fence sitting.
All right, so that wraps us up for this week. Henry, again, thank you so kindly for dropping by and spending some time with us at Dollars and Making Sense. And we look forward to your feedback and comments. And again, we'll see you next week.